For this video, let's have a look at Mastercard, the number 2 payment provider in the world, just shortly after Visa. I think right now Visa holds about 48% of market share, while Mastercard has about 35%. So Mastercard is the runner-up, and therefore of course they have a bit more room to grow. Looking at their revenue numbers here, we can see they've been steadily growing their revenue by 10.3%. And they have done the same for their EBITDA in line with their revenue, which means that their margins are basically remaining the same, which I think is not too out of the ordinary for a payment provider. A 10% increase in revenue and EBITDA is a very nice growth, and if we look at their numbers, we also see a very consistent growth, just like we saw with Visa in a previous video. Their debt level over the past 10 years is relatively low, quite low actually, and it's easily covered here even by 1 year of earnings. So I think it's fair to say that Mastercard is very unleveraged and has no risk of bankruptcy whatsoever. They also have quite some cash on hand in case anything might happen. This money is just sitting on their balance sheet waiting to be used on a rainy day and gives us a bit of cushion as a shareholder. Their market cap has been increasing by 13% every single year, and this does not include dividends because of course if the amount of shares outstanding are decreasing and the market cap is increasing, the value per share is increasing exponentially. So 13% on market cap alone, which are very attractive results here. Enterprise value is growing relatively in line here with market cap. Once again, enterprise value is the entire value of the business. So we take the market cap, to which we then add the debt and we subtract the cash, and then we get the enterprise value. The EV/EBITDA ratio on average here for Mastercard is about 22.5 times earnings. So this means that on average it takes 22.5 years of earnings for them to buy back the entire enterprise value, to buy back the entirety of the business. Now this is a relatively high multiple, but of course you have to realize, just like with Visa, that Mastercard is a very consistently growing business. They have a growth of double-digit numbers here, they have basically no cash, and they are basically growing in line with the economy. I think it's a very stable business, and so of course this warrants a certain premium. On average the premium has been 22.5 times, where in the early years of the decade it was below the 20 times, and for the past 4 years it's definitely been well above that. 2022 the multiple came down to 23.7, which may have been an interesting buying opportunity compared to the 3 years prior to that. Net debt to EBITDA is below the 1 times ratio, which basically implies that Mastercard is in no risk of bankruptcy whatsoever. And of course you have to realize, as a shareholder, whenever a company goes bankrupt, you're the very last person to get your money back. So most of the time shareholders even get no compensation at all if a company goes bankrupt, so you always want to invest in a company that has a very low chance of bankruptcy. Looking at their cash flow from operations, we see a steady growth of 10% every single year. And we also see that their capital expenditure is very, very low. Just like we saw with Visa, the amount of investment that they have to do into the future to make sure that they can keep on running their business is very, very minimal. Of course, they do need a brush of paint every now and again. They do need to have some maintenance for their building and some maintenance for the computers that basically run their entire payment processing business. But apart from that, there's not many expenses. So we see here for about 11 billion in cash flow, they have about 1 billion in capital expenditure, which is very, very nice, and certainly some great margins for this company. If we take the cash flow from operations and subtract the capital expenditure, we get the free cash flow. Now, free cash flow can be used for a myriad of things, like acquisitions of other companies, buying back shares, buying back debt, or paying out a dividend. Mastercard acquires competition, they buy back a lot of shares, and they also pay a dividend. They don't really buy back debt because there's not really that much debt to speak of anyway. So all the cash that's being generated by this business is basically being used to reward the shareholders, which of course as an investor is a very attractive proposition. Looking at their share count here, we can see that they've been reducing their share count by about 2% every single year. For the past 10 years, they've taken about 250 million shares out of circulation, which basically means if you held a share in 2013 and you still hold that one in 2022, your percentage ownership of the company is bigger even though you didn't buy any additional shares. But this is because Mastercard bought back the shares and basically ripped them up in your favor. And this also leads to an increase in free cash flow per share, because not only is their free cash flow increasing, the amount of shares are decreasing, which means that the amount of free cash flow divided by the amount of shares is increasing exponentially, which makes for some very astounding returns here. 13% increase in free cash flow year over year. The share price in 2013 was $83.74, and here in 2022 it has risen all the way to about $350. 15% increase in the stock price alone, and once again this does not include dividends. So the IRR of Mastercard is even higher than 15% here for the past 10 years. So I think the historic numbers that we're seeing here are very, very attractive. The free cash flow yield on average has been around 3%, and I think looking at their financials and looking at their cash flow statement, all the numbers that I'm seeing here are basically in line with what we saw with Visa as well. Of course, Mastercard and Visa, they do operate in the payment processing industry. They basically operate in the same field, so it's not surprising that we see very similar numbers here. But let's see if the expected return for Mastercard is different from Visa. So let's have a look at the enterprise value model. We see here historically for the past 10 years they've been growing on average 10.5%. And for 2013 I'm going to lower this number just a little bit to 8% because we do have some economic headwinds coming up. There are talks about recessions and shrinkflation and all those kind of things. GDP is decreasing relative to previous years, and of course Mastercard as well as Visa are very much growing in line with consumer spending. And if consumer spending is not going up as much, their earnings are also not going up as much. So I'm going to reduce their average earnings to 8% for the first year, but I'm going to give them the 10% for the few years after that, and then I'm going to give them 8% for the remaining 5 years. I'm also going to attach a 26 times multiple valuation to their enterprise value. Historically they've been at 22.5, but this is mostly influenced by the first 6 years of our financials here. We can see here for the past 4 years their multiple has been quite a bit higher. Now I do think that 37 was quite overvalued, but I think the 27, 29, to be conservative 26 times ratio is maybe a more accurate representation of what we can expect in the future. Given this multiple, I expect an enterprise value of $880 million here in 2032. From which we subtract the debt, we add the cash, gives me a market cap of about 876 million. Divide this by the amount of shares outstanding, and I'm assuming here that the amount of shares outstanding remain the same. Of course, if it does decrease, it only benefits us as a shareholder, but for the sake of conservatism, I'm going to keep their share count as is. This gives me a share price 10 years from now for Mastercard of $902.36. Looking at their free cash flow, I'm going to do a similar thing here. For the first year, I'm going to grow their free cash flow by 8%, then I'm going to grow it by 10%, and for the last 5 years, I'm going to grow it by 8%. Because I'm not sure exactly what the future holds, but I want to add some conservatism into my projections, and if my projections still beat the stock market, that's when I'm going to be interested in buying this stock. I'm going to give them a free cash flow yield of 3% in line with what they've been doing historically. Now in all fairness, for the past 4 years, 5 years, they've been slightly below the 3% times. So if you want to have a look at what happens if we give them a yield of 2.5%, we do see an increase in share price by about $160. But I'm going to be a bit more conservative with the yield here, and I'm going to give them 3%. This gives me a stock price 10 years from now of $805.39. Right now, on the open market, I can buy as many shares as I want of Mastercard for $355. If I take both my projection of the enterprise value as well as the free cash flow model, I get an average share price 10 years from now of $853. Simply looking at the price on the stock market itself, this gives me a compounding annual growth rate of 9.2%. But the moment that I include all the free cash flow that we projected in our free cash flow model, I expect an IRR, an internal rate of return of 14.1%, because of course all the free cash flow that we have projected is going to us as the equity owner. It's flowing directly to us in the form of share buybacks, in the form of dividends. So if we include this number, I expect an IRR of 14.1%. And these numbers are very, very similar to Visa. Of course, I think it's important to know that Mastercard is slightly smaller than Visa, so they have more room to grow their earnings, which is also what we saw here for the past 10 years. They have grown their EBITDA by 10% for the past 10 years, while I think Visa has grown it by around 8%. But other than that, I don't think there is much difference into the returns for Mastercard and Visa. I think they are very similarly valued and similarly priced right now, and I don't think any of them has an edge over the other one right now. But let's see what happens if the price does move a little bit. Let's see what happens if the price goes up or comes down. If it goes down by 10%, I expect a 15.6% IRR. But the moment it goes down all the way below the 300 mark, I expect an IRR of around 17%, which I think is very attractive for a stock that is growing as consistently and is as unleveraged with that debt as Mastercard is. So this was it for Mastercard. Thank you very much for watching. Don't forget to like, subscribe, and all that good stuff, and I'll see you in the next one. Cheerio!